last couple of years, we've been working very hard at turning Perseus around from a hopeful producer, as it were, to a company that today is not only is it producing extremely well, but it's very well set for the future. And I'd just like to run you through our story. So, for those of you who aren't overly familiar, let me just give you a quick snapshot. So we're an internationally owned company listed in Australia and in Toronto, West African focused. We're involved in exploration, production and development, of course. We've got a fairly sizable resource reserve inventory, about 7.6 million ounces in resource and nearly 4 million ounces in reserve as it stands today. We've got a very strong growth profile, production profile based on 2 existing mines and a near development project. We've got a fairly healthy balance sheet, which gives and strong cash flows, which gives us the wherewithal to fund the growth that we're looking to deliver. And we've got a very experienced board and management team, and I think that's really an important aspect of the business and one of the assets of the company that's not actually on the balance sheet. All of this together combines to be a pretty compelling investment story. So where we sit today, the share price at the moment is about 43.5 cents or something like that. So basically, the market cap's around 450 odd million Australian dollars. It has improved the share price quite a bit in recent times, but we still think there's a fair bit more in it. And a lot of the cause for the reason why the share price has moved in recent times, I think, is that 2017 was an important year for us. 2016 was pretty horrible when we had to get a few things sorted out along the way. But 2017, we put our head down, tail up, and we delivered the outcomes that the market was expecting us to deliver. So, in summary, we've had a fairly major turnaround in the performance of the Edikan Gold Mine, and I'll go into that a little bit later on. We also pushed forward the development of the Sissingué mine, such that by the end of the year it was 99% complete. In early January, we were able to pour first gold, and I'm very happy to say that a couple of weeks later we hit nameplate throughput rates, and by the end of this month we'll be declaring commercial production. So essentially that Sissingué mine is up and running right now. The other thing we did last year that was important was we did the feasibility study on the Aori project, our third project, and what we were able to demonstrate was that we've got a very, very attractive, both in a technical and an economic sense, third project coming along for us to add to our portfolio, and that will contribute very, very strongly to Perseus in the future. We also put the company into a pretty sound financial position by the end of the year, and we had about 45 million of cash, we had about 50 million of debt. The half-year results were fairly encouraging once you stripped away the non-cash items such as foreign exchange losses and some write-offs that we took the opportunity to do. So we had an EBITDA of about $35 million for the 6 months, which was about a 50 million turnaround on the period in the prior year. So, 2017 was a good year. I think what is important is to understand exactly what it is that we're on about and why we think the future looks particularly good. We've got a very simple strategy, very clear strategy for value creation. And what it is that what we want to do is to successfully develop and operate a number of gold mines in West Africa in a range of geopolitical settings. Now, what underpins the thought process here is that it's never been a good idea to have all of the eggs in one basket. And certainly in West Africa, where things are volatile from time to time, having a number of mines in a number of different countries allows us to spread the risk to a sense where we can have a reasonably reliable cash flows coming forward. So if one country or one mine's not performing, then the others will be, and that gives us a clear line of sight to cash, which is important in terms of our ability to pay dividends to shareholders in the future. Now, that strategy is underpinned by a number of key points. One is a constant drive to deliver improvements in productivity. And you need to look no further than what's happened at Edikan over the last couple of years to see the impact of that, where we've turned that mine around from a struggling situation to one that's actually been generating cash for quite some time. The second thing that we seek to do is to bring new opportunities online as expeditiously as we can, and to deploy capital very efficiently so we don't spend money unless there's a demonstrable return on funds employed coming through. And certainly Sissingué was a good case in point, but also some of the lesser activities that we've been involved with around the Edikan mine over time. We've only done them on the basis that we can prove that they generate substantial returns on funds employed. A key element of what we do over there is to maintain a strong social licence. Now, a lot of people sort of disregard the importance of this and put it in the soft and feeling sort of basket, but the fact of the matter is it doesn't matter how good your people are and how good your projects are. If you don't have a strong licence in that part of the world, then you're going to struggle. And so we do put some effort into that, and we do have very strong relationships in both of the countries in which we're operating, both at a community and at a government level. And that's been very important in keeping us whole over a period of time when things have come and gone. I said earlier about the importance of the experience. Look, the fact of the matter is that over a period of time, we've developed quite a lot of intellectual property in how to work in West Africa. It's not immediately obvious to people that go there, but over a period of time, you kind of figure out who's who in the zoo and how to actually make things work. And that's been terribly important, and it's been the success of the Sissingué development is probably a good example of how knowing how to get the system to work in your favour can deliver strong benefits. So that's what we're doing, and the results are starting to come through. As I said, we're West African focused. As you can see from this chart, we've got the 2 operating mines and the area development coming through, fairly sizable mineral resource inventory and all reserve inventory. Now, coming to Edikan mine, this is a mine that's probably best well known by the market. We started that back in 2011. We've produced over 1 million ounces, about 1.2 million ounces since then. It's been a fairly tough mine. It's a large-scale, low-grade set of ore bodies. We produce gold there quite comfortably. Our costs are relatively high, particularly compared with, say, some of the Australian guys whose costs are based in Aussie dollars. Ours are based in US dollars. But what we have seen over the last 12, 18 months is a steady increase in gold production and a steady decrease in costs, such that now our costs are running around the $1,000 mark, production costs around the $1,000 mark. We've done a lot of work in terms of improving the productivity, and you don't need to look too far to see the individual measures that show that the strong performance improvements that we've been able to achieve. We've got about 6 years left to go on the project, but we're very hopeful that we can extend that. We've got a couple of things that we're looking at the moment, and if we're successful in delivering those things, then we should be able to push that life out. Now, the thing I think that is the key, people say, well, okay, so how come it's taking you so long to get Edikan performing? Well, I think the key to the improvement that we have delivered over the last year or two has really been down to people. And, we now have a team of people over there, largely Ghanaian, I might say, so very few expatriates, a largely Ghanaian team who are very, very focused and very proud of what they're achieving. And I think that, they can take the credit for a lot of the improvement that has been achieved and for the results that we've been delivering. Now, Sissingué, as I said, it's our newest mine. This is a different scale of business altogether to Edikan. Whereas Edikan is a couple of 100,000 ounces per year producer, Sissingué is going to be something in the order of about 70,000 average over 5 years, front-end loaded. But the difference between Sissingué and Edikan is that it's got a very low operating cost. It's in the DFS was around 628. I should say that cost has probably gone up a little over the last 6 months or so as we've seen increases in fuel and a few other bits and pieces. But generally speaking, it's a very low-cost mine, and it's a good cash generator. And we put this one into development about a year ago, a bit over a year ago, and as I said, started to produce first gold in January of this year. Now, a lot of people have said to us, why on earth did you, given that you've got a 200,000 odd ounce producer in Edikan, why did you spend $100 million in building such a small mine? There were 4 key reasons why we did it, and these 4 reasons are, we think, highly valid and are starting to pay dividends. So the first was that the return on investment was pretty good. So at $1,200 an ounce, we're generating about a 30% return on funds employed, which is not too shabby. Second reason why we went ahead with this project was that it's given us a second cash flow stream very quickly. So as of about a couple of weeks ago, we started generating cash from this mine. Now, this is terribly important in terms of that diversification strategy that I was saying about earlier on. Not being totally leveraged to Ghana or not being totally leveraged to the success of Edikan is an important thing for the company, because we do know that things come and go, And having a second income stream has been terribly important. The third reason why we wanted to do this investment was that we were putting at risk $106 million for the construction costs. And through that exercise, what we have done is developed an in-house development team that has got a lot of experience now in operating in Francophone West Africa and in Côte d'Ivoire in particular. They built the project ahead of schedule and on budget, and are ready and poised now to move from Sissingué to our third project, Yaouré. So, in a sense, by developing Sissingué, by getting the experience of operating in this part of the world, we've managed to de-risk to some degree the third development, which is a large-scale development, and that's the one that's coming down the line. As we speak today, I've got the development team in our office over here in Subiaco, and they're going through a lessons learned exercise. So what we're doing is identifying the things that we did well, things that we could improve upon, and all of these things are going to be factored into the execution plan of Yaouré. And as I said, it's important in the sense that it is going to de-risk that third development. The fourth reason we've done this project, and this is an important point, is that we did make commitments to the community and to the government in Côte d'Ivoire about building this project. And having delivered on our promises, I think we can, we've demonstrated to the country that we're a reliable partner and people that can be trusted and counted on to deliver, what they say. Now, this is terribly important in terms of the cultural recognition and acceptance in this part of the world, and I think that in terms of the longevity and our ability to operate in the country, we have put ourselves into a reasonably good place. And once again, this is important because we do want to continue in the country and move on with the Yaouré project. This next slide just shows a couple of photographs. I mean, it's a smallish mine, but it's a really nice little mine actually, and very well constructed with Lycopodium as the main contractor on the job. Our third project, which I've mentioned a few times, is Yaouré. Now, we acquired this project in 2016. We took over Amara Mining PLC, which was a junior UK company. We got a project that a lot of people had looked at and had formed various opinions on, but when we looked at the project, we went back to basics and we worked out what we thought it was worth, and that's what we paid for. Now, as soon as we acquired the project, we put ourselves into an immediate drilling program to confirm that our assessment of the resource was correct. And I have to say that our assessment of the resource was quite different to what Amara had been talking about. But nevertheless, what we were able to do through the exercise was to come up with a definitive feasibility study that has attractive economics, so 27% real rate of return at about $12.50 gold. It's technically very robust, so it's a 3.3 million tonne plant. It'll generate around 215,000 ounces a year for the first 5 or so years at $734 an ounce. Now, as it stands today, the life of the mine's about 8.5 years, but we fully expect that by the time we go into development later this year, we will have announced an upgrade on the reserve, and we'll have at least 10 years ahead of us. The capital cost of the project's about $260 million, so it's readily financeable given where we sit with our balance sheet. And as I said earlier, one of the exercises that we've been very heavily involved in the first few months of this year is looking at that funding process, and we'll be locking in on a funding mechanism in the next week or two, and be setting out to put that funding package in place over the balance of the year with a view to going into development later in this year. And one of the really important things about this thing is that, as I said, we did do a takeover, and of course everybody knows that M&A can be can be quite surprising sometimes. You get a few surprises. The thing is that we got pretty much what we expected to get, and that's really pleasing. In fact, if anything, we got a project that's better than what we expected, and certainly recent drilling around the Yaouré site has given us a very strong level of encouragement that this project's going to be with us for a long time to come. Now, where we stand on the process right now, we are doing some additional drilling on the site at the moment. When we did the DFS last year, we hit a lot of mineralisation in places when we were doing sterilisation drilling. We found mineralisation where we weren't expecting to see it, and so we're drilling that out now, and that'll go into the resource reserve later this year, and that's what I was saying, we'll increase the reserve. So that work's going on now. That data will feed into the front-end engineering and design process. That'll start next quarter. We've got an application in for our licence right now. We'll finish our compulsory community consultation in the next week or so, and we'd expect that licence to be granted around sometime in the next quarter, which will allow us then to start doing some early works. Then with the funding package in place, we should be able to move into full-scale production towards the end of the year and be producing gold from there about 18 months later. Now, what all that means for Perseus is that, and I want to just spend a little bit of time on this slide, is that Perseus is a very different company to many of our peers. I've been speaking at the BMO conference in Indaba and various other places over the last couple of months and speaking on panels, and it's really struck me as quite a contrast between Perseus and other West African countries. Most of the other companies that present themselves will show you a growth profile like that. But nearly all of them are reliant on exploration success or M&A in order to be able to deliver that outcome. This growth profile is based on existing JORC-compliant reserves that we currently own today. So there is no exploration risk involved. There is no acquisition risk involved. There is some development risk because that grey bar is the start of the Yaouré project. But as I said, by the successful development of Sissingué, we've been able to reduce that risk to some degree. There is some financing risk because we do have to put our funding package in place for Yaouré, but I said also too that our balance sheet is very strong and our ability to fund is very good. And so we believe that while there is a financing risk, it's fairly modest. Then, of course, there's operating risk on all three properties. But I think the one thing that we have been able to demonstrate fairly succinctly through our time with Edikan is that we do know how to operate difficult mines. And given that the project, the Sissingué project and the Yaouré project are both substantially better projects in the sense of higher grade, lower cost, we're very optimistic that we can deliver a growth profile like that for our shareholders. And of course, with that growth profile comes free cash flow, and with free cash flow comes ability to be able to return that to shareholders.
Jeff, just on that one, you've got Edikan production dropping off. Will that bite into your cash flow in 2020 and 2021?
It does. It's absolutely right. Sorry, I had to go back on that. But you
get a roll.
do go back. Oh yeah, whoops.
There we go.
Yeah, that's right. So Edikan is starting to drop by there, and Sissingué will be starting to drop. So what that says is that by 2022-23, we have to have a pretty clear view of where Mine 4 is coming from and where Mine 5 is coming from. And so one of the important things when we do our financing for Yaouré is we've got to make sure that we don't do anything that's going to constrain our ability to grow the company. Now, we've got a strong exploration team, and we expect that we can deliver Mine 5 through the drill bit. Mine 4 is probably going to have to be an acquisition of some sort or another, be a late stage exploration play, somewhat similar to the Yaouré project. But you're absolutely right. This is a thankless task because every day you're taking away your resource base, and so they do need to be replaced over time. But when it comes to cash generation and to distribution to shareholders, what we're seeking to do is to get ourselves to a position where we've got a clear line of sight on what the cash flow is, and to be able to have a high level of confidence that we will produce that cash flow, irrespective of whether one mine or other is up and down. Now, having got into that position, what we can say is, okay, X% of that cash is going to dividends, Y% of it is going to replenish the business. And that's where we're trying to get ourselves to. That's why we've been pushing very hard at bringing at least three mines into production at the same time. I think the ideal number is probably 4 or 5. I think if you want to really have a critical mass and have very good line of sight on your cash flow, but we've got to get 3 in place before we can start talking about 4 or 5. And that's certainly something for the future. So what's the proposition then? I said we do have a strong financial position, and that's true, and we can fund our way into that growth. We are on track for delivering guidance. The guidance for this half year is 140 to 160,000 ounces, and looking at the production up until the 18th or 19th of March, we are certainly within that guidance range. I will say we are closer to the bottom end than the top end, but nevertheless we're on track for delivery of that guidance. And I think that the fact that we are financially robust, that we are actually delivering the things that we're saying we're doing, is having an impact on our valuation. Now, while we have seen improvement in the share price in recent times, so we've gone from the low 30s to the mid 40s since the end of last year, We're still at a fairly significant discount to intrinsic value in our mind, and also to the consensus broker NAV per share. So there is still a value gap there that is going to be closing progressively over time, and we think that value gap will progressively close as we continue to build a history of performance and a history of delivery on achievements and a history of de-risking our business. Now, it's very definite that interest is coming back into the stock. As I said, I've been at the BMA conference and in Zurich and in Dharma in the last couple of months, and it's interesting because the institutional investors that weren't prepared to talk to us several years ago are now coming back and wanting to talk about the company and find out exactly what's happening. And all of them are saying to me, look, this is a very different proposition to what we saw several years ago. We think that you're on the right track. This strategy is bang on target in terms of delivering outcomes for West Africa. What we want to see is you continue to de-risk the business, and then we'll invest. So I think sitting on the sidelines is a fairly large amount of potential buying. The challenge for us as a management team is to continue to deliver the results. We've got our quarterly report coming out in about a month from today. I think it'll be or thereabouts. Actually, no, probably a little bit less than that. And while I'm not in a position to talk about what the quarterly is going to deliver, I can say that I've said already that we're on track for achieving our guidance later in the year, and I think that the market will see that the very hard work that we put in last year is continuing into the new year. And so that brings me back to the fundamental point here. What we've got is a company that has gone through some challenging times. We've responded to the challenges. We're starting to deliver significant performance. We're de-risking our business. We're closing that valuation gap. And we think that this is a company that has been overlooked by the market for some time and for some good reasons. But it is a company that is starting to come back into its own. And I think that certainly the Australian gold miners are doing a great job at the moment. Their cost base is in Aussie dollars. They're selling in Aussie dollars. They've got a very big Aussie dollar margin. We sell in US dollars. Our cost base is in US. So there is a difference. But, the cycle does turn. And Perseus is positioning itself very strongly for the next phase of growth. And I think it's a stock that certainly warrants closer examination.